Best ever listeners, welcome to the best real estate investing advice ever show. I'm Slocum Reed, and I'm here with Vessi Kapoulian. Vessi is joining us from Los Angeles, California. She is the founder of DBA Capital Group, which JVs and syndicates multifamily investments. Portfolio includes 161 units GP'd across 7 properties, totaling 13 million AUM, and a small portfolio of residential properties as well. Vessi, can you start us off a little bit more about your background and what you're currently focused on?
Absolutely.
Awesome.
I really appreciate the opportunity to be here, Slocum. Have been a long-time listener and follower of the podcast and
Great.
ever related. So I'll hit on a few key points and we can dive into any of those further as you see fit. Originally from Bulgaria and grew up behind the Iron Curtain. And why I bring that up is because for a long time, the concept of investing for me translated to investing in hard assets. At the time, there wasn't really a developed stock market in Bulgaria. And for a lot of people, what that meant was buying their own home, maybe a second home, and then investing in silver, gold in the form of jewelry. So it wasn't until I arrived to the US that I discovered the popularity of the stock market. Nevertheless, I follow the traditional path of many, which is to go to school, graduate school, and join the corporate organization and climb that corporate ladder. So it wasn't really until 2017 until I started my real estate investing journey. And I don't remember exactly how, but I stumbled across a real estate seminar. It was a 3-day seminar, Friday, Saturday, Sunday, and I took a day off from work and went there excited to learn. It ended up being one of those where you upsell at different stages. So I never really proceeded with signing up for any of those, but I took copious notes and built investment templates, questionnaires that I could start with as I start the real estate journey. Coincidentally, at that time, I also came across an online webinar, which was really a recording of local meetups here in Southern California. And one of the speakers there was consistently showing up, leading discussions, talking about investing out of state. And I picked up the phone one day and called him asking the question, do you sell properties like that, or do you know someone who does? And sure enough, he did. And before I knew it, I had purchased my first investment property out of state. That was in Memphis, Tennessee. Fast forward to 2021, I had since expanded my residential portfolio into Central Florida and asked myself, how do I scale this further? And that naturally led me to consider multifamily. Devoured a ton of content, both book-wise and online. And one common theme that a lot of experienced investors shared, or one common piece of advice they had was get a mentor, a coach, if you want to accelerate your journey along the way. So I looked into a few programs and ultimately chose one that most closely aligned with my goals. My goal at the time was to close on my first multifamily deal within 12 months of making that mental transition to multifamily, or at the latest within 12 months of starting that coaching program. And I'm very happy to share that closed on an 11-unit JV in Tampa in May of this year, and 145-unit syndication in Augusta, Georgia last month. So as they say, the work is just now beginning, but I'm really excited about the journey and what's next.
Are you still working outside of real estate investing, Vessi?
Yes, I'm still working full-time. Gotcha.
Okay. Cool. So aside from the fact that you were born and raised in Bulgaria, this is a fairly common story when it comes to how people get into real estate investing, including involving one of those stepladder seminars. The only stepladder seminar I ever attended was a week-long course. A business partner of mine had already paid for it, and that guru allowed you to reattend with a business partner for free if you'd already attended before and paid full price. So I got to go for free, and I will say while I was in the course learning about, I think I was learning about buying properties on subject to wraparound mortgages. I actually got a lead that resulted in my partner and me buying a house subject to with a wraparound. So I have to say I've only had a positive experience with those. But aside from that, and aside from growing up outside of the United States, this is a fairly common story for how people get into real estate investing and decide to scale. I will say an 11-unit JV and a 140 something unit syndication. With regards to your own investing activity, Vessi, those are pretty different deals. So what motivated you to get involved in syndication as well as continue investing in joint ventures?
That's a great question. I started my journey with residential properties, and my goal there was to have long-term buy and holds. And I look to continue that model through joint ventures. Ideally, I would like to have properties, buy properties and hold them in the long run. Where syndications come into play is being able to create another income stream that's also related to real estate. And I also enjoy working on teams, so it gives me the opportunity to get to know other operators, partner with others, and find a way to add value to that larger group. But it's really uncovering another real estate related income stream that what also attracted me to pursue the syndication concurrently with JVs.
Vessi, you said you're a long-term or a long-time listener of the Best Ever podcast. You may have heard me say maybe like once a week now that I'm a buy and hold apartment owner operator in Cincinnati, Ohio. The buy and hold strategy, especially when you're looking at the long-term hold or the forever hold, is very much a cash flow and wealth building strategy that does not involve large amounts of income up front, but it grows over time, and you're definitely building wealth over time in ways that our fairly sophisticated audience is already aware. Syndication is a very different model when it comes to finances, income, wealth building for investors. So you called it another income stream within real estate investing. Was it, let me ask you, what is it about that attracted you to apartment syndications? Speaking generally, general partners in apartment syndications make almost all of their money with liquidity events and with acquisition fees. So you have a fixed, you're underwriting to a fixed hold period, 3 to 7 years. So there's an acquisition fee up front, very little money in the meantime, typically. And then you're looking to make a lot of money on the disposition 3 to 7 years out. What attracted you to making money that way when you already had solid income outside of real estate and you were already building a long-term hold portfolio?
There are a few things, right? One is the ability to scale. There is something to be said about being able to work on larger, more complex assets. The opportunity to work hand in hand with other investors, both the active partners on the management team, as well as passive investors. And when it comes to passive investors, I'm really passionate about spreading the word about real estate investing. It's something that I wish I had uncovered earlier as a form of again, a more steady investment stream, and really an opportunity to do that full time. Again, I always thought about it as something that you kind of do on the side versus full time. So I really want to be able to empower others to start their journey. So that's another aspect that's very attractive to me about syndications. And again, it ultimately starts with the why, and that's the ability to improve the local communities. Oftentimes that involves improving the asset living conditions, and that's very rewarding to me. Like you said, the hold times are typically shorter, right, versus the buy and hold forever. But there are aspects that are attractive to me, despite some of the medium-term period that you outline, whereby you're not you're patiently waiting, right? And real estate is a long-term game. At the end of the day, it's not about quick results or getting rich quick. And I'm okay with that. I'm okay to be patiently waiting and hopefully finding a way to help others along the way.
Awesome. Yeah, that makes a lot of sense. And I get where you're saying that it gets you into real estate investing full time faster. So you say when did you close on, I believe it was your first syndication?
Yes, that was the first syndication, and that closed in June, so just a couple of weeks ago.
Gotcha. So tell us a little bit more about it. Where is it? What is it? What's the business plan?
Absolutely. It's a 145 unit property, really comprised of 2 assets. It's in Augusta, Georgia. The deal was sourced through one of the partners who lives just an hour or so away from Augusta, and the relationship they have with a local broker as well as the seller. How I got into the deal was really identifying a way to add value to the team through underwriting, the market analysis. I was also given the opportunity to attract capital. It's a Class B, C+ asset. We are looking to improve the property by improving the interior, as well as taking care of some exterior deferred maintenance. The operational opportunity there is the ability to increase rents, which we believe we can accomplish based on the market data that we have. And so we'll increase value, add value to the property, and bring great returns for our investors through those 2 key paths: the CapEx improvements and the operational improvements.
Gotcha. So you, well, let me ask, you closed in June of 2022. Guessing that you got it under contract in spring of 2022. I'm curious about the debt that you got on it. What, based on, well, let me ask, there are three numbers here that I want to ask for all at the same time, Vessi. The cap rate based on actual performance prior to your acquisition, what your debt terms looked like, your loan to value and your interest rate primarily, and your term, and then what cap rate you expect to be able to achieve based on your purchase and your pro forma NOI after you do the CapEx and improve operations.
Absolutely. So the debt terms definitely evolved based on the lending environment. We started with one rate, and we ended up with another that was slightly higher. Nevertheless, we still were able to secure a fixed rate for the first 5 years of the loan tenor.
How much did you buy it for?
I can't disclose the price because for tax reasons. So that's the one variable I cannot disclose, but I can share hit on all the other metrics that you mentioned. So very favorable LTV of 75%, loan rate of 5.1, fixed for the first 5 years of the tenor. Exit cap rate would be right around.
What's the amortization on that?
It's 25 years. Yes, it was through a local lender that one of our partners had a relationship with, so that really helped with securing favorable loan terms, coupled with the overall background of the team. Exit cap rate is right around 5.5%, and starting cap rate is right around 4.8 percent. I believe I answered all questions, but if I missed any of the metrics, let me know and we can go over those.
Sure. So exit cap rate of 5 and yeah. So starting, you bought a 4.8 cap with 25% down, 75% loan to value at 5.1 with a 5-year term and a 25-year AM. Now the exit cap rate, there are a couple of different things that people want to hear from when it comes to that term. What I'm asking is, based on your purchase price, how high will you get the cap rate to go? Not necessarily what cap rate you expect it to sell at. So based on what you paid for it and what you plan to put in it, where will you get the cap rate? Not necessarily the price at which you will sell it, but where will you get the cap rate based on your own purchase and capex?
Yeah, so we're again conservatively underwriting. We're effectively increasing the cap rate at roughly 10 basis points or so year over year. So right around 5.5. Now, if cap rates don't increase further, then we'll obviously gain more, but that's what we're accounting for. Obviously, if they increase more than what we've projected, then we've built in additional cushion by virtue of other levers within the deal, mostly pertaining to expenses, as well as the projected rent growth. So we've baked in additional cushion parameters, if you will, to help us account for any market fluctuations.
Gotcha. So conservatively underwriting for an increase in the cap rate of 10 basis points or 0.1% per year. You know, I have to say, Vessi, I'm asking these questions as someone who has not yet syndicated, neither as a GP nor as an LP. I'm just an owner operator, and I'm more of a BRRRR investor. So based on the numbers that you're showing, your debt has a 5-year fixed term. You have a plan to get the cap rate from 4.8 to 5.5, likely over 7 years. Does your debt allow you to extend beyond that 5-year term?
Yes, it's actually, just to clarify, it's over 5 years. So 5 years is the planned hold period.
Okay, gotcha.
Yeah, the debt is actually a 10-year facility where the rate is fixed for the first 5 years.
Gotcha.
And then it starts floating should we decide to hold the asset later. We haven't necessarily baked in a refi, although that's also an option should we decide to extend the hold period. But this year, 5 years is what we're planning on.
Gotcha. And asking out of personal curiosity, is there any sort of prepayment penalty with your loan?
Yes, there's a traditional prepayment penalty. Yeah.
What is it?
The 54321.
Ah, okay, gotcha.
Yeah.
54321. To me, a buy and hold investor who does smaller deals in Cincinnati, Ohio, that sounds a little aggressive, but it makes sense. You know, the way that my commercial mortgage broker would say it, when debt was really cheap, there were no prepayment penalties because they wanted their money back as fast as they could get it, because they were hoping they'd be able to lend it at a higher rate. Now that rates are going up, prepayment penalties are going up with them, because banks want to keep that debt at 5.1 much longer than they wanted to keep it at 3.1.
Yeah.
Gotcha. So go ahead.
And I was going to say, considering where the market is today, that rate is actually quite attractive as well. So
Oh yeah,
that's another
well,
reason
when
why
did you
offset.
right?
Yeah.
So when did you lock it in?
I want to say it was probably May, right around May. So
Gotcha.
roughly maybe 4 weeks before closing. I may be off by a few days in those timing estimates, but we were ultimately able to lock it in when we got the commitment letter signed from the bank. Gotcha.
Now that we're recording in early July 2022, yeah, I mean, it feels like every 4 or 6 weeks there's a bump in every time the Fed meets, right? There's a bump in interest rates. So that 5.1 is not something that you're going to find now, of course. That makes a lot of sense. So what are you making any projections about where you expect cap rates to be in 5 years?
It's very hard to predict, right? I think it's, if anyone knew where rates would be, they would probably be doing something different. I will say that now, for any net new deals that I'm looking at today, again, this one we looked at a while back, and it was purchased at a very attractive price that unfortunately no longer exists in the market. So for anything that I'm looking today, I'm adding additional cushion when it comes to cap rates. And there are a couple of ways to approach that. Either add more than the 10% that most people increase it by year over year, or start off with a higher cap rate relative to what the market is, which again is not necessarily the purchase price cap rate, but add a little bit more cushion to the starting cap rate by adding to the market base plus that cushion to account for additional fluctuations. I think the one maybe safe bet to make is that with the increase in interest rates, and we've already started to see some movement in the market and adjustment of sellers' expectations when it comes to evaluations. I think the one safe bet to make is that cap rates will go up. Again, by how much, it's probably going to be dependent on the market and the asset class. But those are some of the actions that I outlined earlier that I'm taking to make sure the underwriting is conservative in the current market environment.
Of course. Yeah. And 5 years is a long time, all things considered. And 5 years is a long time in the life of a market cycle. So I mean, we're certainly experiencing volatility right now, but there are no crystal balls that can tell anyone that far into the future what this market looks like, for sure. Awesome. Well, Vessi, are you ready for the best ever lightning round?
Yes, I am.
Awesome. What is the best ever book you recently read?
I like how you qualified it recently. Otherwise, it will be a very, very long list of favorite books. But the one that comes to mind is The One Thing by Gary Keller. There are lots of golden nuggets, but it's a great book about life and productivity. And the one common theme throughout it is, what is the one thing that you can do today that will make things, everything else seem unnecessary or easier? And that's really helped me structure my days, my weeks as I plan ahead. So I'll highly recommend it.
Nice. Yeah. Fabulous book. What's your best ever way to give back?
A couple of ways. One is I contribute to animal organization ASPCA. So I don't talk about it publicly, but that's one thing I do, as well as helping other real estate investors. One of my core powers is underwriting. So I'm always happy to get on the phone, answer questions, help others underwrite deals, or provide a second set of eyes.
Awesome. Vessi, so far in your commercial real estate investing career, what is the biggest mistake you've made and the best ever lesson you learned as a result?
There is one deal that comes to mind, and I learned that lesson relatively early on through my residential investing journey. And it was when I was purchasing a duplex, and there were many reasons why I liked the assets, but as I started the diligence period, there were also a few red flags that ultimately caused me to walk away from the deal. I did lose my diligence money, which was a couple $100, which I realized when we talk about multifamily in the grand scheme, it may not be a lot, but for me, it was a lot of money at the time. But there were a few valuable lessons that came across that I learned along the way. One is being persistent about being able to see all the units. We were not allowed initially to see one of the two units, and ultimately realized later why. It involved a lot more capex than what was represented to us. and there were inconsistencies in the lease, the tenant, and the arrangements that the landlord had with that particular tenant. So being able to walk all the units, being disciplined about it, and I felt devastated when I quote unquote lost that deal. But at the end of the day, it's about cutting your losses or sunk costs, as I call them. I would have loved to own the asset, but the red flags were just too many for me to proceed. So having the strength and being true to your core criteria, core investment criteria, and following those through was something that I learned early on, and that I think has served me well.
Awesome. Yeah, that's something that a lot of us come across coming up through residential real estate investing, is that we don't do due diligence, or we don't learn how to do due diligence to the degree that successful large scale commercial investors do, and we allow those kinds of lapses. Buy a 4-family after seeing only one of the units because the other 3 were hidden from you. It's got to be a really good deal for that to work. So that's awesome. And best ever lesson, of course. Yeah, do your due diligence, be thorough, and don't. Even when I've had properties as large as 70 some odd units under contract, I was walking every single unit myself with an inspector during due diligence. So I get where you're coming from. I've made that mistake myself too. Vessi, what is your best ever advice?
I would say to the listeners to dream, believe, and achieve. Dream, because it's important to have clarity of goals. Dream big, know your why, follow your passion, believing in yourself, overcoming your own limiting beliefs by surrounding yourselves with positive, like-minded individuals, mentors, coaches, a supportive community, and achieve, because none of it matters if you don't take action. So focus on making that first step, as scary as it seems, but take that first step, and then the other and the other. Be consistent and persistent, and before you know it, we will be well on your path to making those dreams a reality.
Awesome. And where can people get in touch with you?
The best way to get in touch with me is through my website, dbacapitalgroup.com. My contact information is there, more information about our investment approach and criteria, as well as a ton of free content that I've posted there and will keep adding to.
Awesome. That link is in the show notes. Vessi, thank you. Best ever listeners, thank you as well for tuning in. If you gained value from this conversation with Vessi, please do subscribe to our show. Leave us a 5-star review and share this with a friend that you know we can add value to as well. Thank you, and have a best ever day.